Okay, the writing is on the wall. The news is coming in thick and fast, but don't take my word for it. Take a look at these next couple of clips.
Problems on the production line. Why a quarter of company bosses are expecting a tougher time in 2019. And beware the credit crunch. Bendigo Bank calling on the regulator to spell out responsible lending rules.
Okay, Bendigo Bank is one of the smaller banks, regional banks, not part of the big four, so it gets affected differently as a result of the just ended Royal Commission. So see what the CEO has to say.
Well, ANZ CEO Shane Elliott was bang on last year when he announced the golden age of banking was over. Commonwealth Bank reported last week its first fall in profit in 9 years, and NAB also warned its margins are under pressure. Bendigo Bank today revealed its bottom line has been hit by rising costs and falling margins. Net profit dropped 12.3% to $203 million. The net interest margin, which says how much they're making on loans, dropped 2.7%. I spoke with Managing Director Marnie Baker from Melbourne. Marnie Baker, many believe the Royal Commission was soft on the major banks. In your view, what recommendations will prevent future bad behaviour?
Lisa, the Royal Commission final report that was handed down, I think, was quite extensive and measured in its approach. I have been quite vocal around that there is some further work that the government could do to extend on what's come out in the Royal Commission final report, along the lines of some more pro-competition initiatives to help to level what is an uneven playing field at the moment. And as you know, with an unlevel playing field and a lack of fair competition, then that's when you see some of these poorer behaviours occur.
It's been reported
Unleveled playing field, that's for sure.
Looking at your results, your net interest margin was down, your funding costs and business costs were up. It's a similar picture at the other banks. Do households need to prepare for higher interest rates? That's really the only lever that you have.
Look, there's a number of levers available to banks and to ourselves. Yes, we are seeing the pressure coming in on revenue at the moment, which means we do need to focus in on the underlying costs of our business to ensure that we're operating in the most efficient way that we can. But even within the...
Yeah, well, she is not going to use or play along that question where Elise was asking whether they are going to have to lift the interest rates, because that would be a political and probably business suicide. It's just not something you say. It's not a popular thing to say. So she says there's many other levers to improve their financial position, but in my opinion, they're just going to have to push up the rate or cut the rate of the savings accounts. As always, Elise has really good questions. What about this next one?
On the flip side, Reserve Bank Governor Philip Lowe changed his stance last week and rates could now be cut. In your opinion, do households need a cut?
I think the bigger concern is the availability of credit at the moment.
That's it. She hit the nail right on the head. It's the availability of credit. This is what I keep saying, is that the houses wouldn't be worth $1 million in Sydney and close to that in Melbourne if it wasn't the easy availability of credit. Just imagine, would you ever have saved even close to $1 million? And if you did, would you really shove all that money into the house? You'd be saying, this is too expensive. I've spent years and years and years saving this $1 million, and now I'm supposed to pay $1 million, all this money to this one house. You wouldn't do it. So the availability of credit is absolutely totally correlated to the prices of the houses, or the prices of the houses are correlated to the availability of credit. There's no doubt about that.
The correction in property prices have made made it more affordable for most Australians to be able to get access to credit. But working through things like responsible lending and understanding the requirements that the regulators have on lenders in relation to that, I think is a bigger thing that we need to focus on.
Okay, she was asked what the biggest challenge is when it comes to the regulators, and she said regulators actually defining what it means to be responsible lender. How many payslips, how many statements does a borrower need to provide before they're deemed as safe to be lent money to. And then this interview continues with this.
Is that one of the key reasons for the downturn in house prices that we're seeing now?
I think it goes towards what we're seeing now, yes.
How much worse do you think it's going to get?
Yeah, I think there's still a bit more of a correction to come. I think there's a bit more pressure to be placed on it over the next 12 months. Outside of that, it's actually hard to make a call at this point.
Marnie Baker, thank you.
Thanks, Elise.
Okay, so the availability of credit is one of the biggest factors when it comes to property prices. Anyone cares to guess what the other one is? Let's have a look.
Australians are cheering a potential cut in interest rates. The RBA's change in rate stance lifted this month's Consumer Confidence Report. The Westpac Melbourne Institute Consumer Confidence Survey jumped 4% in February to a 103, meaning that optimists now outnumber the pessimists. Comfort with household finances picked up slightly, but there's rising stress over falling house prices in the major capital cities.
Most consumers in New South Wales and Victoria now expect further price declines over the next 12 months, and clearly that has a feedback to activity and demand as to whether you delay purchases and so on.
Westpac expects the RBA to remain on hold into next year.
Okay, so what that says is that most consumers are expecting Sydney, Melbourne and the rest of the country prices to go down, meaning that the confidence is low. So that next factor is confidence. If you are not confident it's going to continue to go up, you're not going to borrow no matter what the interest rate is. Okay, we're not going to leave it there. We've got another segment to show you.
The property portal Domain has taken a $180 million hit to its bottom line, a victim of the cooling property market. The company posted a net loss of $156 million for the half year after writing down the value of its digital business, dragged down by fewer property listings in Sydney and Melbourne. Shares surged today, but the company has lost around 40% of its value since listing after splitting from the old Fairfax Media Group. It comes after rival online real estate company REA Group last week reported a 98% plunge in its profit following write-downs in its Asia business. The markets ended.
Okay, and just a little bit more for you.
Kyle Rodder, reporting season is certainly playing out on the market this week, and today Domain shares rallied despite a massive write-down.
They were really happy with some of the guidance that came out of Domain. Now, of course, the issue was the write-downs there. That was very much tied back to the fall in listings associated with the fact that the Australian property market has obviously come off in such a considerable way. So you could probably assume...
Okay, the Australian property markets come off and down in such a considerable way. There's fewer listings for Domain.com.au, which is a large real estate market portal to sell, buy, rent housing. So that tells you one thing. I am going to create another video coming up. I think the next video is going to be about why I think that the property, residential property, really shouldn't and isn't an investment grade asset. I'll make my I suppose arguments as to why it really isn't and shouldn't be, but until then, have a good day and we'll talk to you soon.